In this video, I'll provide a review of AbbVie and what I personally look for when evaluating potential dividend stock purchases. In the first section of the video, I'll run through what the company does and how they make money. Then I'll look at some of the numbers and metrics that I find useful in evaluating companies, as well as looking at the dividend history and also the company's revenue, net income and cash flow. And finally, I'll offer my own individual thoughts and opinions on the stock. So who are AbbVie? AbbVie are a global giant in the pharmaceutical industry. They develop, manufacture and market advanced medicines and therapies that address some of the world's most complex and serious diseases. AbbVie were once part of Abbott Laboratories, another healthcare conglomerate who decided to split the company into two separate entities. Abbott Laboratories would specialize in products including medical devices and diagnostic equipment, while AbbVie would operate as a research-based pharmaceutical manufacturer. And in 2013, AbbVie was officially listed on the New York Stock Exchange. AbbVie's portfolio of products includes a broad range of medicines that solve serious health issues across several key areas, such as immunology. These are drugs that can modify the immune response, either by enhancing or suppressing the immune system. They're used to fight infections and to prevent and treat certain diseases. Oncology is the study into the prevention, diagnosis and treatment of cancer. Neuroscience is the research and treatment of issues concerning the brain, such as Alzheimer's disease, bipolar disorder, depression, and Parkinson's disease, for example. AbbVie's eye care products address needs and new approaches to help preserve and protect patients' vision. AbbVie also develops therapies for the gynecologic care of women and oral contraceptives. And lastly, aesthetics. AbbVie's aesthetics portfolio consists of toxins and dermal fillers, plastics and regenerative medicine, body contouring, and skincare products. If we now have a look at AbbVie's revenue split by category, we can see that over half of all sales income comes from immunology drugs, with 53% of the total. Oncology is next at 16%, followed by other drugs at 12%, aesthetics at 6%, neuroscience 6%, eye care 5%, and women's health 2%. In 2020, AbbVie completed the acquisition of Allergan for $63 billion. Allergan makes pharmaceuticals, medical devices, and consumer healthcare brands. Thanks to its acquisition of Allergan, AbbVie now has more than 120 additional products in its lineup that generated more than $16 billion in sales last year. One of Allergan's most well-known brands is Botox, which helps with the temporary smoothing of facial wrinkles. If you were to invest in AbbVie, then it's important to understand the business model of a pharmaceutical company at a high level. In very basic terms, pharmaceutical companies discover, develop, and sell drugs. When a new drug product is developed, the drug's formula is protected by patents that last for 20 years from the date that the patent application is filed. When a drug is protected under patent, it's called exclusivity. Exclusivity gives the drug company a bit of a monopoly on the drug until the patent expires. With effectively no competition for a drug with exclusivity, these drugs produce substantial amounts of revenue and profits for the company. It's basically a cash cow until the patents expire. Once the patents do expire, competitors then flood the market with cheaper copycat drugs, referred to as generics, and the sales of the original drug tend to severely decline. Pharmaceutical companies are well aware of this, so while they're reaping the rewards of a golden goose drug, they're often reinvesting a portion of those profits into research and development to identify and develop the company's next big blockbuster drug. Securing approval to market a new pharmaceutical product requires substantial effort and financial resources, and takes several years to complete. Organic innovation isn't always easy, so mergers and acquisitions are very common in the industry, as bigger players will accelerate new growth by acquiring smaller companies, and therefore absorbing their research. Speaking of research, it's clear to see that innovation and research are absolutely key for the success of a pharmaceutical company. And if we now have a look at the research and development spend of AbbVie since their incorporation in 2013, we can see that they've been consistently pumping more money into this year over year, going from around a $3 billion spend in 2014 to around a $6 billion spend in 2020. To put this into context, that figure was around 13% of total revenue last year. This is pleasing to see as an investor, as this is what will ultimately drive new streams of revenue. However, it is important to note that due to the nature of the pharmaceutical industry, there is a high rate of failure in bringing drugs to market, for reasons such as inability to demonstrate a drug's effectiveness, safety concerns, or excessive costs to manufacture. So not all of the spend will be worthwhile, and a lot of cash will be wasted on research that doesn't yield positive results. But I suppose that's just the nature of the beast in any type of research. Let's now have a look through some of the metrics that I find useful in evaluating stocks. AbbVie has a current dividend yield of 4.67%. Last year's dividend yield averaged at 4.4%. So it's an encouraging sign for dividend investors that the yield has increased. It just means that we're able to get more dividends for our money this year. It's also worth noting that there has been a real increase in dividend yield over the last 2 years, when we look at the yield historically. With AbbVie only forming in 2013, they only have a short dividend history, but have increased their dividend every year since inception 8 years ago. Over the past 5 years, the average dividend per share growth rate was 15.66% per year. This is a really high dividend growth rate, and it remains to be seen whether this level of growth can be sustained. The payout ratio is currently 173.53%. This just shows the proportion of earnings a company pays shareholders in dividends, and is expressed as a percentage of the company's total earnings. With payout ratios, obviously the lower the percentage, the better, and I tend to consider around 80% as being a high ratio. So it is worrying that AbbVie are over 100%, and this just requires us to look a little bit deeper into this. So looking at the payout ratio history of AbbVie, we can see that typically the payout ratio does fall under 100% more often than not, and the average ratio for the period shown on the graph is 95%. Although this figure is clearly skewed by the ratios in 2014 and 2020. With the payout ratio exceeding 100%, this means that AbbVie are having to pay out more in dividends than they're receiving in income, which is obviously a problem. So in this instance, I'd like to have a look at the cash balances that the company holds at the end of each financial year, just to see what funds they have to potentially fill in the shortfall. So looking at this graph, we can see that AbbVie tend to keep around $8 or $9 billion in their cash reserves, which is good to see. 2019 looks like a bit of an anomaly, where the cash balance shot up to $40 billion and then dropped back down again in 2020. Looking into the financial statements for a possible reason behind this, I did see a figure that jumped out at me in the cash flow statement, which was $31 billion proceeds from issuance of long-term debt. Now, to translate that into something more understandable, it just means that they've taken out a loan to borrow this cash, and it's hit their account. So, to confirm this, we look into the liabilities section on the balance sheet, and see that long-term debt and finance lease obligations jumped from $35 billion to $62 billion. We know that AbbVie purchased Allergen in 2020, so it looks like this loan was used towards the purchase price. It is hard to see the exact amount without having access to the full transaction listing, but I'd be very confident that that's what's happened here, which just explains the jump. The market cap of AbbVie is $195 billion US, which makes it the 37th largest company in the US. I do like these large blue chip companies in my dividend portfolio, as they tend to be established, steady organisations, and the dividends tend to be more reliable than smaller cap companies or new startups. AbbVie has a current share price of $111.38, which does put it in the top end of the 52-week price range. The current price could be seen as being a little high when you compare it to the 50-day average of $107.10 and the 200-day average of $102.46. So this just shows that we have seen a recent price increase for the stock. So now let's look at the dividend history of the company. As AbbVie were only incorporated in 2013, they do have a relatively short dividend history. But what we can see is quite a steep upward trend, where the dividend has increased from $1.60 in 2013 to $4.72 in 2020. This is a compounded annual growth rate of 14.48%. This is something I like to see as a dividend investor, as it shows me that the company is committed to not only paying dividends each year, but also increasing them too. Businesses that can grow their dividends at a steady rate and maintain a consistent payout can generate substantial wealth for shareholders over the long term. Now let's have a look at the chart showing AbbVie's revenue, cash flow and net income. While it is important to analyse the dividend history, we should also have a look at the potential earning power of the company, as the revenue and profits will dictate forward dividend payments and possible increases. The first thing I notice is the steep increase in revenue, especially over 2020. This is very satisfying for me as an investor, as it shows a continued and increasing demand for their products. Net income appears to be a little erratic, with the line jumping up and down a bit over the period. But if we look at AbbVie's profit margin, we can see that although it does drop to the 9% mark a few times, in general it tends to be around 20 to 25%. A good profit margin will vary considerably by industry and size of business, but as a general rule of thumb, a 10% net profit margin is considered average, a 20% margin is considered good, and a 5% margin is considered low. So for AbbVie to be hitting an average of 19% is really pleasing for me, and shows good management of their expenses. The cash flow is also very pleasing for me, and we can see a clear upward trend, averaging around a $9.5 billion cash inflow each year. Again, this is really good to see, as if a company can generate a consistent positive cash flow, then it should be able to provide a return for investors, either by using the cash to grow the business or to pay dividends to shareholders. So for AbbVie to have a consistent and reliable level of cash inflow each year bodes well for the future of the company and future dividend payments, providing these levels can be maintained, of course. So what is my opinion on AbbVie? AbbVie are a massive player in the pharmaceutical space and quite a beloved dividend growth stock among dividend investors. One thing worth discussing is AbbVie's patent for a drug called Humira. Humira is the world's top-selling prescription drug and brings in roughly $20 billion in annual sales for AbbVie. Key Humira patents in Europe expired in 2017, which has allowed generic drugs to sell for a fraction of the cost. Unsurprisingly, this has resulted in drastic sales declines outside of the US. Humira's patent in the US expires in 2023. This has had negative connotations with investors who realise Humira's importance to AbbVie's revenue. While it definitely is an important matter, I don't think investors should avoid the stock simply due to this, as expiring patents are just part and parcel of the drug industry. When investing in pharmaceutical companies, it's really crucial to look at their pipeline, which is just an assortment of products and services at various stages of their development. With the acquisition of Allergan, AbbVie is diversifying its pipeline, which includes neuroscience, gastrointestinal, women's health and eye care. Allergan's pipeline totals approximately $15.7 billion in revenues that are being absorbed into AbbVie's existing business. Allergan also has the #1 branded product in multiple aesthetics categories, all with a really high market share. In addition to the recently acquired Allergan assets, AbbVie is developing some pioneering growth prospects within its own pipeline. AbbVie has 2 products in their early life stages, in Skyrizi, for the treatment of psoriasis, and Rinvoq, for the treatment of rheumatoid arthritis. In fact, looking at AbbVie's financial statements commentary, we can see that net revenues for both Skyrizi and Rinvoq increased more than 100% over 2020. These 2 new immunology drugs had 2020 sales that came in at just over $2 billion. AbbVie's management predicts that the two products could combine for $15 billion in annual sales by 2025, which could almost replace the lost revenues of Humira alone. And it's also worth noting that Humira's sales won't completely disappear just because the patent has expired. I do feel that investing in the pharmaceutical industry is much riskier than other sectors, just due to the demanding and challenging need for constant innovation. An inability to bring new products to market would eventually cause the downfall of the business. However, for me, I feel like I'm taking a calculated risk in investing in AbbVie, as although they will likely be losing a large chunk of their Humira revenue, I believe that this gap can be bridged through their own pipeline of products, plus bootstrapping onto Allergan's portfolio as well. I think that sometimes, with increased risk, comes increased reward. And a dividend yield of 4.67% justifies this risk for me personally. I currently hold 13 shares of AbbVie, and unless the stock falls back under $100, I'm not sure I'll be adding to it just yet. I do like the company a lot, but I would like to monitor the situation over the next couple of years before potentially adding to my position. Remember that this isn't financial advice, and you should always do your own research and due diligence before making any investment decisions. I hope that you've enjoyed the latest video in my stock review series. If you have, please like the video and subscribe to the channel to make sure that you don't miss out on any future videos. Please also feel free to check out some of the other stock review videos I've done on my channel. Also, let me know what stocks you'd like me to review in the comments section below. Thanks again for watching, and I'll see you on the next video.